Microsoft lost about $440 billion in market value in a single swoop. After reporting strong numbers. That sounds impossible until you see it like a poker table where someone just got cooler. Here's why this matters right now. The AI race has shifted from demo hype to infrastructure reality. Companies aren't just shipping features. They're buying chips, building data centers, and locking in massive commitments. Those commitments might pay off later, or get outdated fast. And markets don't only ask, did you grow? They ask, at what cost, and how soon does that cost turn into profit? Rare, high upside events can be worth aiming for, but only if the environment is right. They're only worth it if you can afford the slow bleed while you wait. A cooler happens when two strong hands collide, and one player wins a defining pot. You can't force that moment, but you can position yourself so the payoff is asymmetric. Microsoft's AI strategy is that kind of bet. Accept years of heavy spending for a defining enterprise AI moment. Microsoft's earnings showed plenty of strength, revenue growth, strong cloud performance, and rising adoption in products like Copilot. And yet the stock sold off hard. The recent context points to one word, Capex. Spending surged, driven by AI data centers, GPU, and infrastructure. Raising fears hardware will depreciate fast and returns will arrive late. Imagine a poker player who says, trust me, I'm setting up a monster pot. Then you watch them pay blind after blind, losing small pots for an hour. Even if they're playing well, the table starts thinking, how long can this last? And what if the big hand never comes? In AI, massive infrastructure spend can be rational, but it looks like bleeding until the payoff becomes undeniable. The excerpt talks about being big on obvious boards because opponents can't fold second-best hands. In markets that board is the story investors see. Growth, margins, risk, dependency. Microsoft has a huge demand backlog, and a large portion is tied to OpenAI. That doesn't automatically mean trouble, but it concentrates perception of risk. If one partner slows, what happens to the forecast? In poker terms, it's like representing a super strong range, while everyone knows you're leaning on one specific card. When the table notices, they don't pay off the silhouette. They get cautious, or they punish you for it.
AI isn't just a tech bet, it's a confidence bet.
Concentrated dependencies can make the market less willing to call your big raise, even when your hand looks strong. Chasing rare events is only smart in deep stack environments, where an eventual win outweighs small losses. In shallow stacks, it's suicidal. Microsoft is a deep stack player, huge distribution, enterprise relationships, and the ability to integrate AI into daily use products. If AI becomes as embedded as spreadsheets or email, the payoff will be enormous and durable. The market sentiment act in shallow stacks. They want clarity that the spend converts to returns before the next wave makes today's infrastructure feel old. The context highlights investor anxiety about depreciation and delayed ROI. Deep stack strategy meets shallow stack patience. The business may be positioned for long-term asymmetric reward, but the market's timeline can be much shorter. The poker lesson isn't don't chase big wins. Only pay the entry fee for rare upside when you can survive the waiting.